a very good evening to everyone who is present here. Thanks for joining in, uh, and also wishing all the women out there a very happy Women's Day. So the last few weeks have been very turbulent, right? I mean, especially the financial markets and of course the commodity markets. We have seen Russia and Ukraine get embroiled in a war. Uh, this is of course causing a lot of disruptions, and the major disruption has been across Europe. The energy markets have been the worst hit, with crude price taking a massive jump from almost $85 to $130. The skyrocketing crude price means that a surging import bill is imminent for countries like India, and it has a negative consequence for the world economy. To discuss all of this and more, we have got Mr. Sahil Kapoor, who is the head of products and market strategist at DSP Investment Managers. In fact, whenever Sahil writes a thread, or whenever they publish, every time, and he tells us every single time to leave everything and to go through the report at the priority. So Sahil has a great hold over the macro view, and his tweets and publications have been extremely informative for readers like us. So with that, Sahil, thanks a lot for joining in, and I hope everyone present on this space will immensely benefit from your hold over the macros.
Thank you, Aditya, for inviting me.
So with that, Sahil, let's get at it. My first question to you is, we have seen a dramatic rise in the crude oil prices, right? So can you explain why these prices are surging and how does it affect the Indian economy?
Sure. Aditya, I'm audible correctly, right?
Absolutely,
yes,
sure.
Absolutely, very clear.
Cool. Okay, cool. So I'll give you a brief background on how I see this. So first thing is that this is, of course, everybody understands this is a geopolitical plus oil and gas kind of a crisis. And you could equate this to any large crisis which has occurred earlier in the history, whether it was, let's say, the oil embargo in the 1970s, or the formation of OPEC, or let's say the Kuwait war in 1990. And very similar price moves. If you go back in history and see crude WTI, NYMEX surged from about $16 to $41 very quickly in 1990s when Iraq invaded Kuwait. And there are many other similar examples. And one that quickly comes to mind is September 2019, although all of us don't really remember it. But there was an attack on Saudi facilities then. And two facilities were impacted, which are very crucial for Saudi Arabia to supply oil to the world market. And almost about 5 million barrels per day of oil went out of the market. And prices went up for a few days, but then they declined, right? So why I'm telling you these events, that oil and gas market is very, very large. And the price moves are dictated by how the market is balanced at present, at that point in time. So, for example, between 2011 to 2018, we had the whole Arab Spring happening. Many Middle Eastern countries seeing a huge political upheaval. And during that course of period from 2011 to 14, oil prices remained over $100. And then they slid rapidly and they went under $30. So we saw both the sides during a period of great turmoil in the oil market. So the idea is, what is the underlying demand and supply balance of the oil market? And that decides how big an event and how big an impact would be. So if you look at the numbers, and just to fix some numbers in our mind, let's say the oil market is about 100 million barrels per day. That is the oil consumption and production, roughly balanced, to each other. Oil market goes into deficit and surplus of very small numbers, where the producers keep on, trying to balance the market out. And the number is, let's say, slightly 101, but I'm just taking the ballpark number of 100 million barrels per day. That is the demand and supply situation for oil today. So if you remove, 5 million barrels per day, as what happened on September 2019, it's a huge shock to the market, right? And today what is happening is that market is now estimating how much of oil will get impacted because of what is happening between Russia and Ukraine. Let's look at a few numbers, right? The top producer in the world for oil and gas is United States. It was not the top producer 2014, before that year, and it used to be a large producer, but not the top producer. Today, it is the biggest producer of oil and biggest producer of gas. I will give you the numbers for gas also. But in case of oil, United States, let's assume a steady state 2019 numbers, the pre-COVID year, they produced about 12 million barrels of oil per day, the biggest number. Russia produced about 11 million barrels per day, and Saudi Arabia, the third largest, produced around 10 and a half. These are the big three of oil and gas today, and the importance of these countries can be gauged from what happened in April onward, COVID year 2020 April onwards. There was a price war. OPEC could not reach an agreement with Russia to cut supplies, and they said that rather than pumping less oil, I'm going to pump more oil because nobody is agreeing to cut production. So Saudi Arabia started pumping more oil. So if you go and see the data, the production actually went up. The idea is that these big three now control the oil market completely. OPEC more or less is becoming redundant over time, and therefore it formed OPEC plus. OPEC got in Russia, and if you look at the numbers, OPEC produces around 30 million barrels per day of oil. Right now, the production is lower. They went in cuts, and they are now raising it very, very slowly. It's at about 28.5 million barrels per day, but they can produce around 32 million barrels per day, right? So that is OPEC for you. The large member, Saudi Arabia and other countries, you can just quickly Google and see. Then out of the OPEC, X of OPEC, there is Russia, which is the largest one, and then there is United States. This is 50% of the world market, all the producers put together. So OPEC Plus and Donald Trump reached an agreement, which was ratified or, so to speak, created by Donald Trump to, get all these nations along, and consensus was reached to cut supplies during COVID and balance the market out. So it's very important. United States enjoys higher oil prices. It is the largest producer of energy. There is no merit or positive for US to see lower oil prices. Plus, why this crisis is becoming important in terms of, let's say, oil. Russia supplies, as I said, around, let's assume, 10 million barrels per day of oil, 10% of the market. And it consumes around 2.5 to 3 million barrels on its own. The rest of 7 million barrels is what it exports. The question today is how much of that oil is going to get hurt? How much of that supply will not come to the market? Whatever oil is flowing through pipelines from Russia to Eurozone and other countries, specifically Japan or China, specifically China, that oil is still flowing as we speak today. All the oil which goes through VLCC and containers, that has become a problem, because companies have imposed self-sanctions. Companies are saying we don't want to deal with Russian companies today because we don't know how will we get our money, right? So that is a big problem. And that is what is leading to a very large mispricing of markets. Markets do not understand whether this number is 2 million barrels or 3 million barrels. And as I give, just to give you a comparison, as I gave you a comparison of September 2019, 5 million barrels went away from the market. With, let's say, on that day, there was not a lot of clarity how will it get back, although Saudi Arabia repaired its facilities very, very quickly and also used its inventory to repair it. Today, the underlying market is very different. In 2018-19, the world was flooded with oil. People were talking about oil glut, that we have so much oil that we don't have demand. Today, the oil inventory globally is at almost 8-year low, 10-year low in most countries. OECD stocks are at 6-year low, right? The inventory levels are absurdly low globally, not only in Eurozone, even in US, even in Asian countries, the levels are very, very low. And that's why the prices are spiking, because of this condition that if you have a 2-3 million barrels per day shortfall, it could lead to a very, very large uptick in prices because countries will not be able to secure demand, right? So that is, I think, reason number one why oil is spiking. And of course, there is a theory saying that what could be the permanent hit to oil supplies. There could be a permanent hit if Russian oil goes away from the equation completely. And that is something that the market still does not understand, and even for us, it is very difficult to understand whether that scenario is possible or not. So these two reasons, I think, are the key.
All data points that you keep giving us, they are very brilliant, that is it. So one quick question that I really had here is that we are now seeing that oil is possibly in backwardation. I'm not updated about the latest futures prices that are there. So oil is in a backwardation process. So is the market predicting that will there be a Iran deal that is going to come up, and that will that release some bit of oil? Or what is the market exactly trying to price in when it is saying that I am going into backwardation on the futures contract of oil that is there?
Sure. So it's very important to understand what does the future market do. Backwardation is an abnormal market. Normal commodity market is when prices, let's assume that we are sitting in March 2020. Let's say the price of a commodity, let's say oil is $100 today. So for a futures contract for, let's say, April 23, 1 year from now, the price should be higher, because you have to store oil and you have to pay cost for storing that oil, which is in commodities called cost of carry. So in a normal market, the curve is upward sloping, which is called a contango or a normal market. But backwardation occurs when spot prices are very high. And this occurs because of two reasons. Right. One is that if there is a supply shock, which we are seeing today, or there is a massive demand boost, either of the two. And historically, we've seen both happening. So as of now, what the market is expecting is that there is a very, very large fear that they will not be able to get it oil that they want today or let's say in the next 1 month. And therefore, this backwardation is very, very high. Just to give you the, let's say, the extent of backwardation, right now the backwardation is about $17, $18, the 1 year number, which is extremely high. And we haven't seen this number since 1990s from the date the data is available. On an intraday basis, this went as high as $27, which is a spike. But this tells you that the market is completely off the hook. अगर आप इसको बदला देखेंगे in a very true sense of the futures and forward market, it's giving you a free money of about 17-18% if you just roll it over at $100, which is insane because dollar rates are 10-year yields are not even 2%, right? So backwardation is pricing in a very, very large supply cut because of the war, which is very clear. And secondly, historically, this kind of steep backwardation has mostly coincided with market tops. So, and but of course, I don't know where the market top is, and it's very difficult to talk about it in real time.
Definitely.
Yeah, but roughly this is the scenario. This kind of wide backwardation is generally the markets do not hold on to it.
Hold on to it, yeah, definitely. So then let me come to one of the most hot topics that you keep following. Is this that now we are at such high oil prices, and in some economies it is definitely going to push inflation. So how do you think that the central banks are going to behave? How do you think the Fed is going to behave with these high oil prices? And what are the consequences on the interest rates that are there, considering that crude is now up from 85 to about 120?
Sure. So first thing, let's, in terms of what US does or the Fed does, I think there is not a big drag on US growth because of high oil prices, although you will hear a lot of noise. It does shave off a bit of GDP in terms of a few basis points. But in the last 10 years, the complete transformation in oil and gas industry in US has added the maximum number of jobs in US. And it has added a huge amount of, let's say, the huge block of GDP to US growth. So oil and gas is a very positive development for US, unlike what we hear in the press. It has a very large bearing on US making more money and becoming self-reliant. Second important piece, I think the Fed is probably going to hike rates. I haven't seen any Fed governor coming and talking about a number. Many Fed governors say that they're going to, let's say, hike rates or they are going to do something or act. But I haven't seen a Fed chairman coming and saying that I'm going to probably hike rates by 25 basis points. So it's very clear that Fed rate hike has already happened. It's just operation announcement in March.
Operational numbers, correct.
So I'll be very surprised if they don't do it. I think it's already done. Second thing, I don't see that they are going to hike a lot more because US 10 minus 2 curve is already very flat. As we speak, I think it's at about 25 or 30 basis points at max. So I don't think they have a capacity. So that is the only indicator from a monetary policy or from a central banking perspective that we should monitor at least for the next 10-15 days. And I think so that's on Fed. And for RBI, I think it's a bigger issue, and we have to deal with a number of factors. And first is, what are the channels which will hit Indian finances? And the biggest one for oil and gas is, of course, our oil trade deficit, which becomes very high when oil prices go up. Right? If you look at India's balance of payment, and if you break it up in current account and in financial and capital account, in the current account, most of the items don't move a lot. So, for example, we do a services surplus. हर महीने हम 8-10-11 billion dollar का surplus करते हैं. So, for the full year, we get about $110 billion in surplus by exporting services. We get about 80 billion by by NRIs. So, all the NRIs who remit money to India, that is about $80 billion. So, we get this $190 billion. And then we pay some royalty payments and primary income of about 38 billion or so, right? So let's assume 40 है, तो 150 billion का buffer बन गया. इसके सामने what we do is we have a oil trade deficit of X number that I'll talk about, and we have a goods trade deficit X of oil. जब जैसे हम mobile phones import कर रहे हैं या any other equipment, engineering goods import कर रहे हैं, capital goods import कर रहे हैं. So जो net number है, it's about $100 billion. That is roughly our non-oil deficit. अब जो oil deficit है, let's assume कि oil आज $100 पे है. If it is at $100 today, our deficit will be roughly about $140 billion. We will export about 78-80 and import about $220 billion of oil. The mathematics I put in the thread, I don't want to go into detail, but so roughly $140 billion is something the deficit will come to. So if you add all these numbers, 140 deficit plus 100 deficit is 240, and about 150-160 is the surplus that we did, right? So roughly $85-90 billion ka hole bachta hai. How do we cover that? We cover that with FDI. We get $45 billion in FDI. About, let's assume, $10 billion in FPI flows in debt and equity markets. And then banking capital and ECB loans constitute another, 25 billion. So, agar oil 100 pe rehta hai, we are comfortable. India will have some problems, some issues, but we will, we can go through it. But if oil spikes, let's say it goes from 100 to 110 or 120, every additional $10 move on oil adds about $15 billion in deficit. तो जो deficit मैंने आपको 140 का बताया, $100 पे वो 155 हो जाएगा, 110 पे, 120 पे 170 हो जाएगा. It's not linear. Of course, there will be variations on how domestic and international demand is panning out, but let's assume it is linear. So roughly around $125 to $130, it becomes a problem for us. Our deficit goes and hits a number which we will not be able to service in the present circumstances. So that hits the rupee, or rupee will start depreciating if that happens, right? And mind you, these numbers are dependent on oil trading at this level for a full financial year. And agar oil 125-130 pe rehta hai for 1 month and then drops back below 90, India will not suffer too much. It will have like a few weeks of problem, which is not too much, and we can easily go through that using our very large FX reserve. But if it permanently stays high at 120, 125, then we'll have to find sources to cover up our import bill, right? Which we don't have practically. So it will result in a demand slowdown, right? So just to give you a rough calculation, let's assume that oil stays at $130, for a full 12-month period. 100 की जगह 130 हो गया है. This difference of $30 will add maybe 45 billion to our deficits on the current account, and that could shave off anywhere between 150 to 300 bips from our GDP growth, over a period of time. That is how the stringent and massive impact would be from oil shock. And उसकी वजह से रुपया वीक होगा, और अगर रुपी वीक होता है, then RBI has only two ways to defend it. Either come and sell dollars, that means run down its FX reserve, which is again a chicken and egg. आप जितने FX reserve गिराओगे, रुपया उतना वीक होगा. It's like a defense mechanism. और दूसरा तरीका है raise interest rates, to what Russia did. 9.5 से 20% कर दिया, which is like an unbelievable move. But you raise rates, to protect your currency, which is a vicious circle. You can't really exit it very easily. And I think that is the biggest channel where oil hits us.
Understood. Yeah. Thank you, Sahil, for the elaborate answer. So, in the midst of all of these problems, there is one more problem that has cropped up, is the shipping industry, right? Freight rates have increased a lot. There have been container shortages. So how do you think this will affect the worldwide shipping industry, and what's your outlook on it?
Yeah, I've seen that, as per the data, even the container rates have again moved up by around 3-4% over the last 2 weeks. They are already at a multi-year high. I think container rates, the index was at $9,200 per 40 feet container. Plus the shipping rates, have gone up by 10 times this week. I hope it's just a short-term blip, but it definitely adds to cost. The insurance cost goes up by 3 to 5%. So it definitely makes it more difficult for the global trade to sail smoothly. And I think that hits a lot of sectors which are dependent on exports, right? Particularly the goods export. And that is something that we'll have to be very careful about, specifically for the Asian region, because there was a lot of containers which come from Ukraine and Russia. Their supply has dwindled over the last few days, and that could be an area of concern for the next few days also. So until and unless this stabilizes, those rates could remain high, but there is some spare capacity in terms of how China will open up, and it has been opening up quite quickly, and it could come and take up some of that hole which has come up. So I think it's a short-term issue, but here to stay at least for a month or so until this whole thing normalizes.
Sure. One more thing that I think a lot of us need clarity on is the rupee. It has depreciated above 77 yesterday, and I believe RBI had to intervene. It went to 77.15, and now it was at 77. So what do you think? Do you think there's a risk of a further rupee depreciation?
As I explained, I think if you pencil in, let's say that oil remains at 130 or higher, there is of course a risk of rupee depreciation. You can't rule it out. But I will give you 2-3 important differences. Let's say the most easiest way to compare the current period is with FY12 and 13. When rupee depreciated significantly, we had very high fiscal deficit. We had a very high trade deficit because of oil prices shooting higher. Very similar setup to what we have today. And if you read commentary from a lot of economists, they are saying कि फिर से वैसा setup बन रहा है. If oil continues to remain high, we might have similar problems. One area of defense which is very easy to see and people talk about is that the FX reserves are very healthy at 650 billion. But one key difference that I see, and please note this point very carefully, after 2008's GFC, India got $100 billion in equity flow between FY9 and FY12, FY13 in 4 years. $100 billion in equity inflows. Over the last 4 years, Indian markets, after pricing in what rupee was doing, and therefore which led to a very large depreciation of the rupee, and our FX reserve are also not, reserves are much higher. And the biggest joker in the pack, inflation. At that time, we were running a double-digit inflation on both WPI and CPI. Today, the numbers are much lower. You can debate about it, how low or how high they are, but they are not in double digits, and they are much in control than they were in 2012-13. And I think these two factors are very important. And if we assume that this war doesn't escalate to the next level, and let's say oil prices don't go to whatever 150 or 180, and if they, after this resolution happens, whenever it happens, it slides down below $100, I think we'll be okay. I don't think we'll have a lot of issues.
Sure. I mean, that's a very heartening to your side, and I'm very sure that people who had a lot of concerns are well assured that everything is well with the economy, and we are well placed to absorb that shock. So, one sector that has been one space that has been garnering a lot of investor interest is the commodities space. All the commodities are on fire; they are surging like anything. Look at nickel. London Metal Exchange had to suspend contracts over there. So, what's your outlook on the metal space?
So first is, I think what has happened in the last 10-15 days, we should not extrapolate it. Particularly for nickel, I think it's a margin call issue, which is, I think Bloomberg and Javier has covered it very, very well. There is one single entity which got caught with very, very high margin calls, and they had to suspend the contract. And I won't be surprised if it falls just like it has gone up. So if it has gone up from whatever $30,000 to $1 lakh, I think in a matter of days it'll be back to whatever 35-40 degree of margin calls occurring, and I try to explain that in one of my threads on oil, and that probably caused a huge surge in a number of commodities as well, not only oil, right? And second important point, if you look at the long-term trend for a number of metals, which has been steady, since COVID began. Let's say copper has almost gone up by 2.5 times. And there is a general consensus building. I don't know whether it is a consensus or not, that commodity prices, specifically metals, will continue to remain high. In fact, in the morning, I answered a question saying whether this is a 10-year trend or not, a decadal trend. So that I don't know whether it is a decadal trend. Nobody knows. So if you pick any country in the world, not going into numbers, most countries are not witnessing demand which is commensurate with a commodity super cycle. The other factor is the supply side. There are hosts of issues. There is no denying the fact investments have been low, and all the events which have happened, COVID, non-COVID, everything has hit supply immensely. But let's take a step back and think about this sitting today. What is the probability that in the next 12 to 24 months, demand will be weaker and supply will be higher, versus probability that demand will be higher and supply will be lower? I think the probability of supply side issues reducing and demand becoming weaker are much higher than the other way around. So I will be very, very cautious in extrapolating the current commodity prices. And probably if you're talking only about commodity prices, I will be extremely careful. If you're talking about commodity equities, then I think the view will be slightly different in terms of how the companies are operating. But purely in terms of metal prices, I think it's a time to be very, very cautious.
Sure. So, with all of these events in place, Sahil, what is your advice to equity investors? How should they play the markets?
So my guess is that I think two things. First is that these events are not very easy to price in, right? There is no template to price in, let's say, a war-like event. First, how I think about it is that since the World War II, we haven't seen any two nuclear powers escalate, and go on the battlefield and fight with each other. It hasn't happened, right? Whatever we say, whatever conflicts that we've seen over time, they haven't really culminated into a full-fledged war. So let's assume that remains the case. Not assume, let's hope that is the case, and start with that as a scenario. And if that is the case, you look at if there is any funding stress developing in the interbank market. Today, the answer is no, as of now, right? I told you the data for FRA, OIS spread. You can look at many data points. Look at VIX, look at junk bond yields, you look at corporate bond yield spreads for many countries. They have moved up, but they haven't moved up enough for you to. So therefore, I think what you go back to is go back to the board and see how markets are and where valuation comfort is emerging. And you take that call and probably just to give you an idea, I was sitting on a very, very low equity exposure, which is not a recommendation per se because I'm a conservative investor, but I've raised my equity exposure by about 18% over the last 3-4 days from an abysmally low number. But I think that is a strategy that I'm going to follow. So if we continue to fall, I continue to raise my equity exposure. I find no reason to, let's say, on an aggregate basis, not a great parameter to look at, but let's say if Nifty trades at 15,000 or 15,500 with 850 rupees EPS for FY23, we trade closer to 18 times. There is no reason to time the market. So I will probably look at sectors like healthcare or auto or banking, which I think, or engineering goods and infrastructure, which appears to be in a very good, strong cycle for the next 3 to 5 years. So my advice will be to up equity exposure slowly. Make a list of indicators which will probably help you in deciding whether this is a Six Sigma event or not. If they don't flash red, then probably you continue, deploying peacefully. I think that is the strategy that I'm following.
Thank you, sir. Thank you, Sahil. So, a final question for you before we open it up for Q&A from our, participants.
Yes.
At DSP, you guys publish these Netra reports, right? And
Yeah.
these are the reports that look at the key numbers of economy. So, according to you, what are some key numbers right now, and what do they really indicate?
Sure. So one of the most important number for me is, of course, what is the nominal growth going to be? At what rate is Indian GDP going to grow? At a base case, that number is very important. I suspect that if we do, let's say, 11-12% of steady state nominal growth, our numbers will be very good. I think our base case real GDP growth will be around 6-6.5%. On a best case scenario, and we add, let's say, 4.5-5% inflation to that, we are talking about 11.5 to 12% of nominal growth. That is the starting point. Second important number to look at right now is how much banking credit is growing. I think that is one of the single most important indicator for the health of the economy today. If it continues to improve like it is doing for the last 2-3 months, it will be a good strong number for Indian economy as a whole. So that is the indicator number 2. Number 3, I want to see how overall my tax revenues are, getting priced in. Because 2 numbers to look at tax revenue. What is the aggregate growth in, let's say, indirect taxes like a GST, and what is the real GDP growth? If both these numbers start to grow, that means economy is also doing well. Plus top lines are also going to improve, or they are already improving. Very, very solid foundation, right? As of now, only GST is improving. Real growth hasn't really picked up. So it's like a langdi tang ho raha hai, it's like a one-legged race. And second commensurate indicator is how much of energy am I consuming, or let's say oil imports in tons, energy intensity, not intensity, but energy consumption. Let's say from the prism of how much oil am I importing in terms of volumes, in terms of barrels or tons. If that number begins to improve, I think there is a good likelihood that economy will do well. Signs are good. I think most of the numbers are indicating that our growth is normalizing. Again, you have to keep in mind the event that we are discussing, Russia-Ukraine. If there is a spanner, numbers will change. As of now, the numbers are improving. So I think these 3-4 numbers are the key to watch as of now.
Thank you, Sahil. And thanks a lot for patiently answering all of the questions. I think we have a lot of speaker requests, so let me just add them and they can just question you.
Yes, please.
Raja and Maulik, you guys are speakers. If you anyone of you wants to ask a question, please go ahead.
I have one question to ask. The question is,
Yes.
now we are faced. Now we are facing issues in Ukraine and Russia. Okay, due to this, oil and other commodity prices are increasing. Okay, at the same time, if Fed has decided to increase the interest rate, and as well as they are going to bought the more securities, means what will happen in for emerging markets? these two things happen in single time, means what will happen in emerging markets?
So first is that many of the emerging markets are themselves energy exporters. So for example, it is Brazil or let's say Russia or many other countries. They themselves are energy exporter and they actually gain when oil prices go up. Although this is not a great time for them because of the reason for oil prices to move up. So it's not a very simple equation. Prices move up above a certain threshold, which, for example, in today's session, I said is about $95 or so. India begins to underperform most of its emerging market peers. But for other emerging markets, it's a good situation to be in because if they are net energy exporter, they make a lot of money. They get more dollars. Second thing is that whether central banks will raise rates or not, it's very clear that most central banks will normalize monetary policy. And Fed because let me give you one number. US corporate bond yield, 5-year corporate bond yield, was at 2% in December 2019. Okay, before the pandemic began. Once COVID set in, it went to 50 basis points, a cut of around 1.5%. It is back to 2% today. Markets have already reverted, whether it is the bond market, whether it is the commodity market, whether it is the currency market, everything has reverted. Right now, the markets are surprised why central banks are taking so long. So I don't think 1 or 2 rate hikes are going to derail anything as of today, and it will not cause a lot of damage per se. Yeah, that's my understanding. Thank you.
Bharat, I have made you a speaker. Can you just unmute yourself and ask a question, please? Thank you.
Yeah, sure. Thanks for the opportunity. So my question basically is regarding this commodity. So we have seen that commodity
Yes.
has already been rising up so much from the March low. We have already discussed a lot about the commodity super cycle. So what's your view on because RBI also released some report in last 2-3 months back that they said this rise in commodity cannot be seen as a commodity super cycle, while the many West report from the Western research paper shows they are saying we are in the commodity super cycle. So what can we expect in the term of commodity super cycle, even after, let's say, Russia and Ukraine issues get resolved? Then what overall the scenario would be?
Sure. So see, it's very difficult to gauge whether there is a 10-year cycle or not, as I said earlier. I think the key of today. Whichever indicator you pick up, whether it is the demographics or incremental GDP addition or investments into let's say core industries globally, everything is going down. Even the biggest consumer of commodities is China. That is also slowing down. And so I don't see that there is a very large demand side trigger for commodities. There is, of course, supply side problems. So what I see is there could be bursts of short cycles in commodities, which is very commodity specific. You could have a cycle where, let's say, copper does well over a period of time while other metals don't do so well. Or as you are seeing with oil, right? You could have similar circumstances in a number of agricultural commodities. But I don't see a secular, let's say 2002 to 2008 kind of a 2002 to 2011 kind of a commodity cycle where every commodity goes up. I think that scenario is blown out of proportion in my mind, and it's mostly a recency bias with what we have seen. I don't think that is the
return. That is what we can conclude from this.
Yeah, of course. I think you will have to be an expert in the last few years, or at least a few quarters, and I think it has more legs over time. So if you get volatility in that cycle, you are better off in participating that story rather than trying to look at commodities which are very a huge amount of oversupply globally, but the prices are doing what they're doing, right? So it's an idea which is very difficult to capture through equity markets per se. But if you're trading commodities, I think it's a very different ballgame. If you're talking about trading commodity futures, then I think you will have to be very specific and have to get your risk controls in place.
Sure. Thank you.
Thank you.
So I think folks will take that as the last question. Again, thanks a lot for asking some really thoughtful questions. Thanks for joining in. And of course, Sahil, a very big thanks to you for sharing your knowledge with us. I was just continuously taking notes on what you were saying. So definitely it has been a great learning session for me and our participants. So thank you.
Thank you, Aditya, for having me here. Thanks a lot.